There are over $7 trillion sitting in money market funds right now, which is really close to an all-time high. With rates peaking, is it time to move cash off the sidelines and into fixed income? We're going to break down the data, the risks, and the playbook right here on UBS Trending. Hi, everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thanks for being with us today. My guest in the studio is Tim Ackerman from Transamerica. Tim, good to have you back.
Thanks, Anthony. Appreciate you having Transamerica and me on.
Yeah, absolutely. We love our partnership with you all. I want to talk about this story of over $7.25 trillion that's sitting in money market funds right now, or cash instruments, CDs, et cetera. We keep telling our clients and our advisors, look, you've got to put that money to work. And I think it bears repeating, and also to have someone like you, a great partner like Transamerica, reiterate the fact that it is time to put that money to work. Why should we be rethinking our cash allocation right now?
Anthony, thank you. Yeah, we have a campaign going on nationwide called the Great Cash Reallocation. We're talking to all of our partners about it. Just think about the numbers. In 2019, we had $1.5 trillion in money markets and cash sitting on the sidelines, right? We have 600% growth in that. Now, all the reasons make sense, right? Your clients were concerned about the pandemic. They got real rates of return, actually, getting almost 5%. And it made sense for all that time. Mm-hmm. But guess what? Things are changing. Mm-hmm. And we're really concerned that if you're not looking at those returns, you're going to leave money on the table. So we're moving towards, advising clients, hey, let's take a look at this.
Right. I mean, we were just talking before we started. You're looking at Treasury rates right now as the benchmarks, of course. And if you can stand the duration risk and go out to a 30-year Treasury, you're getting paid 5.1% on Treasuries. You look at some of these muni equivalent, bonds that are out there, these instruments, and some of them are at 6.5% to 7%. I mean, the amount of rate that you're getting for putting your money to work, it's unbelievable. There's so much opportunity out there.
The opportunity is correct. And just let's take a lesson from history, right? If you take a look, and not a political statement, but if you take a look at the Trump administration's 1.0 focus, it was really the stock market. They gauged economic success on what the stock market did.
Yeah.
If you take a look at recent comments from the Treasury Secretary, he said, you know what? We've taken a different focus. We're really looking at fixed income right now and how fixed income will be the leading indicator, specifically on the 10-year Treasury. And you know what they always say, don't fight the Fed?
Yeah.
And now you've got don't fight the Fed, and you have the administration focused on lower rates. And they're not just waiting on the Fed. They're actually saying this time, hey, you know what? We're going to step in and let the Fed do what they do, but we're going to go focus on deregulation, lowering taxes. And that means that we're going to be facing down with lower rates. And your cash on the sidelines is not getting what it used to get.
Right. Then that's exactly the point. And by the way, we do here at CIO expect that the Fed is going to start cutting rates at the September meeting, and we think a total of 100 basis points between September and sometime in 2026, probably 25 per, And so there is the expectation that rates are going to come down. So the question is, when you look at some of the past cycles where, the number's never been at $7.25 trillion, but when we've seen a lot of cash out there, what does the history tell you about when people are taking that money, putting it to work, talking about rate peaks and what we're actually seeing versus right now?
Well, you know what? We have two data points that have recently changed that we really should take a look at. We have CD rates that have gone from 5.9% to 4%,
right.
A 32% decline, and nobody noticed, right? Mm-hmm. But there we are, 32%. We also have, as of this past Friday, many other brokerage firms on the street had a 4.08% cash sweep account. Super attractive. People were just leaving it there.
Yeah.
As of this Monday, we're standing at an average on the street at 2.83, or a 31% decline, right? So these are knocking at the door, and no one's making a big splash about it, but you're slowly losing, those returns. And, Warren Buffett says, take a page from him.
Yeah.
Warren Buffett says, you know what? You know how you build a solid foundation and how you win over time? Sure, home runs are great, but absolutely pick up those nickels and dimes, right? And that's what we're talking about, the great cash reallocation.
Yeah.
You're leaving nickels and dimes all over the place and you're not picking them up in your portfolio. If you're not picking them up, like Warren says, the returns are not helping you.
I
right?
love that analogy too, because I'm sure every single person watching this has some jar at home that has, just hundreds of quarters and pennies and dimes, and you dump that out in one of those machines at the bank, and all of a sudden it's $1,000 worth of change. And you don't look at it and think, oh, that's a lot of money. But in your scenario, in your analogy, that's exactly right. Those nickels and dimes make a huge difference. So, I mean, that's the why, right? That's the why we should care.
It's absolutely why I care. And actually, my brothers and I have two brothers, and I can tell you my parents used to have that jar, right? And I didn't have a great machine at this grocery store. I had to
count
them and
push
put
it in
them
the
in
paper?
there,
Yeah.
right? And I used to catch my brother being like one of those. But hey,
Sneaky.
sneaky, right? But hey, no. I mean, honestly, that is true, right? I mean, that's how we get ahead in this game, right? And we have to focus on the entire portfolio. And if we're just looking for the home runs, right? Billy Beane, right? Moneyball. He says that you got to get on base to win.
That's right.
And this is just getting on base, right? Hitting singles. This focus on the great cash reallocation is literally that. Picking up the nickels and dimes to add to your portfolio. And locking in rates now, as you guys are talking about, is a perfect time.
Yeah.
Right?
Because you're actually, what you were talking about just a couple minutes ago was we are starting to see the rates slowly decline. So if you're not getting in now and you wait another month, 2 months, 6 months, you might miss out on hundreds of basis points in a difference. And we know when compounding comes into play, that's a massive, significant difference in your portfolio.
So where's the alternative, right? I mean, we're now seeing, you can see the flows, just look at the industry flows. You're seeing flows just inch up onto the short end of the curve, right? Like short duration, short-term bonds, right? That has had a big carry right now. And people are taking a look. Advisors are paying attention to that, and they're doing what is in best interest of their client and moving those monies, right? Because no one's advertising that we reduced the sweep rate from 408 to 283,
That's
right? I mean, they're still promoting, a great CD rate because we want them, but they're eroding 32% less, right?
It's a big difference.
Huge.
So here's the big question, and kind of using that Billy Beane baseball analogy, how do you win the pennant? How do you go all the way to win this, in the sense that should we then be taking our money, all of it at one time, and throwing it into some fixed income instruments? Is it a gradual increase? Are there particular parts of the asset class that you think hold the most value right now? What are your thoughts on that, Tim?
Yeah, I mean, it's literally the Billy Beane thing.
Yeah.
It's picking up nickels and dimes. It is really just legging into an opportunity. We don't know where rates are going. The trend is down, obviously, and we're seeing it. So, legging into these short duration opportunities, the real short end of the curve, short-term bonds, really, that'll make up the difference. It'll keep the volatility in your portfolio down, we believe. And I think that it's a great opportunity to take a look at.
Yeah. Any particular parts of the asset class that you think hold the most potential value right now? Is it munis? Is it, is it something with mortgage-backed securities? I mean, what do you think about that part?
Yeah, I mean, we really believe like a diversified portfolio. I mean, honestly, we wouldn't feel comfortable making one particular bet, but a diversified portfolio, right? I mean, is really just the best way to go.
I appreciate that answer, because we say the same thing. You want to have a really nice diversified basket of some equities, some, ex-US instruments, different parts of the fixed income asset class, and even some alternative investments. So that seems to be a really successful portfolio right now.
Right, just look at the $7 trillion. Is that diversified?
Right.
We don't think so, right? I mean, we've seen that 600% growth. So, hey, take some of that and redeploy the asset, right?
Absolutely. Tim, thanks so much. Good conversation. Great
Great to
energy.
see you.
And everybody loves a baseball analogy. So anyway, thank you for doing that. Good to see you. Tim
Good to see you as well.
from Transamerica. And thank you to our great partners at Transamerica for helping Tim make his way into the studio today. And thank you all for watching. There's a lot more information on our Insights website, ubs.com/views. Plus, you can take a look at all of the places where we are on social media, UBS, I mean. We're talking about LinkedIn and Facebook, as well as Instagram. You can follow us at UBS Trending. We've got lots of great content from the studio there for you. And as always, if you have any questions about what Tim and I spoke about today, please make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.